Welcome back to the channel. In today's video, we are going to look at some of the most talked about IPOs of 2025 through the eyes of a value investor. Many of these companies are still trading close to their IPO price. Some have corrected sharply, while a few are commanding premium valuations. But the question is, where does the real value lie for long-term investors? Let's break it down in simple terms. Let's start with the companies that look undervalued or attractively priced. Galaxy Medicare is one name that immediately stands out. The stock is currently around 36 rupees compared to its IPO price of 54. At a price to earnings of just 20 versus a healthcare sector average of 32, this looks meaningfully undervalued. The business has stable operating margins around 14%. And the company has a niche focus with an export-driven model. Risks remain on the regulatory and pricing side, but if their R&D pipeline and export orders hold up, this could be a hidden gem for value investors. Saatvik Green Energy is another interesting story. It listed at 460 and now trades just below that at around 440. What makes it attractive is the valuation. The company is trading at a PE of 21 compared to a sector average of 37. With revenue growing 28% year-on-year and profit growth of 22% last quarter, it looks like the fundamentals are backing the stock. The company is expanding capacity and stands to benefit from government subsidies in renewables. Of course, risks like policy changes and raw material costs need to be tracked closely, but for investors looking for growth at a fair price, this one deserves attention. The third undervalued idea is Accelerator, a non-banking finance company. The IPO was at 61 rupees, and today it trades around 53. At a PE of 22 versus a sector average of 26, it is reasonably priced. The company is showing strong asset growth of 30%, improving NPAs down to 1.5%, and a steady return on assets of 2.3%. The management seems disciplined on underwriting, which is a plus. But since it is in the financial space, one needs to be watchful of regulatory changes and interest rate cycles. Still, for long-term value seekers, it looks like a decent pick. Now let's move to the middle ground. Companies that appear fairly valued. GK Energy trades around 168, almost in line with its IPO of 171. With a PE of 28 against a sector average of 31, it looks neither cheap nor very expensive. The business model is stable, backed by power purchase agreements and presence in rural electrification. Profitability has been improving, though the capital-intensive nature of the sector means debt levels and CapEx plans need close tracking. Pratik sales is another name in this category. The stock is at 235 compared to its IPO price of 247, with a PE of 21, slightly above the sector average. Revenue is up 26% and margins are steady at 15%, which is commendable. It has a wide distribution network and a diversified product base, which should help it weather competition. For investors, it makes sense to track new product launches and how well the company retains its key clients. Nilachal Carbo also sits in the fair value zone. It trades at 75, a bit below its IPO price of 85, but commands a PE of 23 against a sector average of 19. What's encouraging is margin expansion, with PAT up 18% year-on-year and EBITDA improving to 16%. The company has long-term client contracts in custom chemical manufacturing. Risks are mainly around raw material inflation and environmental regulations. For deeper analysis, investors should focus on contract renewals and ongoing CapEx execution. Finally, let's talk about the overvalued or premium plays where caution is needed. Sampat Aluminium trades at a PE of 24 versus a sector average of 19, which means investors are paying a premium. The company has improved margins and posted a 15% PAT growth despite raw material cost pressure. Strong supply contracts and a good client base are positives, but volatility in aluminium prices and forex exposure make it risky at these valuations. Krupalu Metals is even more expensive. The stock trades at a PE of 31 against a sector average of 24. While the company has grown export orders by 40% and has operational efficiency, the risks from commodity cycles and currency fluctuations are very high. Unless global demand strengthens, this premium valuation looks stretched. And lastly, VMS-TMT, a regional player in steel bars, is trading at the richest valuation in the pack, a PE of 38 compared to a sector average of 24. Profits are growing at a healthy 20%, and it enjoys strong regional market share. But given the cyclical nature of steel and volatility in input costs, paying such a high multiple could be risky for value investors. So to summarize this analysis, the real value seems to be in Galaxy Medicare, Saatvik Green Energy, and Accelerator. These are the names trading at attractive valuations relative to their sectors. GK Energy, Pratik Sales, and Nilachal Carbo are fairly valued, good to track, but not screaming buys. And finally, Sampat Aluminium, Krupalu Metals, and VMS-TMT are commanding rich premiums where the margin of safety looks very low. As always, remember this is not financial advice, just an analysis meant to guide your research. Do your due diligence, track quarterly results, and focus on management commentary before making any investment decisions. If you found this video useful, don't forget to like, share, and subscribe for more such value investing insights.